Hi, guys. Chris Ingram here. Thank you for joining us in our second quarter webinar. For the second time in a row, I am joined by my partner, Robert Clark, who's going to help us get through the webinar today. So thank you for joining us, Robert.
Yeah, the enthusiasm there was unreal, so I really appreciate it.
Yeah, you're welcome. It's been a long day. So again, thanks to you guys for joining us. We are going to go through the webinar. We have quite a few slides, lots of information to share. I say this at the top of every webinar that we've ever done. I'm going to try and get this done in a timely manner and not keep you guys here forever. Made a major mistake our very first webinar of going like an hour and a half. I promise we are not going to do that today. So we're going to get going right away and jump off into what is happening here in 2024 and what do we see for the remainder of this year. And let's go to our agenda, the things we're going to talk about. We're going to talk about economic indicators, things that we've seen recently that are showing us where the economy is and where we think it's going. A little bit of a market review, talk about where the markets have been the first half of this year. Talk about the Magnificent Seven and their dominance and their impact that they're having on the overall markets. And then we'll wrap it up with a little bit of talks about this election that's coming up. I'm sure some of you guys are either thinking about it, heard about it. You know, there's a new candidate out there. So what does that mean? And what does that mean for your portfolio? So we're going to talk a little bit about that as well. Let's hit off with economic indicators, roll into that next one there. What has happened recently? Well, we got some GDP data that came out recently showing us that in the second quarter, GDP was at 2.5%. That was better than expectations. The market liked that. That means the economy is actually doing relatively well. I saw a headline the other day and it said, worst recession ever. And then it broke into all the talks about how funny it is that everybody thought at this time we would be in the worst recession ever. Everybody was calling for a recession last year, and we are kind of in the opposite of that. We're in a very healthy economy that seems to be doing just fine. Unemployment data, unemployment is at 4.1%. We'll dive into that a little bit more here in a second. That shows kind of a weakness in the labor market, but that might not be such a bad thing because the Fed has been saying for a very long time now that they actually wanted unemployment to go up. So that might be a good thing with regards to what the Fed's decisions look like moving forward. And then latest inflation data is right about 3%, which is also a decent indicator of what the Fed might do here in the near future. Unemployment. So I just mentioned unemployment at 4.1%. You can see that little chart on the left-hand side. We were stuck in that 3.5% range for quite some time. And as you can see, right about a year ago, we started to see that trajectory move north. And recently has ratcheted up quite a bit, moving up over 4%. We haven't been there for quite some time. But again, the Fed has been saying for a long time now that if inflation data came down and they really want it to be right around 2%, we're right now about 3%. They said if we can get closer to 2%, but if we can also see that unemployment data kick up, which shows weakness in the economy and a potential for less consumer activity and inflation to move down further, that might be the catalyst for them to start lowering interest rates. With the unemployment rate ticking up here a little bit and that inflation data starting to come a little bit lower and closer to that 2% range, it is setting us up for a place where we may see the Fed make a move here soon and start to lower interest rates, which we've been looking for all year long and they've been teasing us with all year long, but it hasn't happened all year long. So everybody's wondering if we're going to get a rate cut this year, and if not, what that might look like for next year. Interest rates, going back to just that. So the Fed, has been teasing us all year long about, their desire to lower interest rates, but it hasn't really happened. This chart is showing us where interest rates have been, going back all the way to the 80s, and some of the recessionary indicators that have happened. So Some might say that lowered interest rates, or when interest rates are dropping, is in recessionary times. Maybe it's creating the recession. But a lot of times, really, what I see from this chart is when we lower interest rates, that's typically what we use to stimulate the economy and help dig us out of a recession. So when things get tough and the economy starts to slow down, the Fed, typically one of their tools that they're going to use to try and reinvigorate the economy is that they're going to lower interest rates. And you've seen that through every recession that we've had, where the Fed has gone into a tight or a lowering interest rate environment to try and stimulate the economy and bring that economy back. As you've seen recently, we've had a huge spike in interest rates on the right-hand side of that chart, and it's starting to roll over a little bit in anticipation of what the Fed is potentially going to do here soon. The difference being is that we're not in a recession yet. So if the Fed is going to lower interest rates here soon, prior to us getting to a recession, you'll still hear a lot of people talking about the potential for a recession on the horizon. Well, if the Fed starts lowering interest rates before we ever get into a recession, there is a chance that we avoid a recession altogether. Obviously, we'll have to wait and see how that plays out, but the Fed seems like they're a little bit ahead of schedule. Wouldn't you agree?
Yeah, completely agree.
Yeah. This is our fixed income portfolios. So we wanted to highlight this right around that interest rate talk, because it is going to be one of the big factors of how these couple of portfolios are going to do moving forward. So we've had a lot of success recently with our capital preservation fixed income portfolio. That's our bond portfolio. There's no stocks in that portfolio. It's all fixed income and bonds and fixed investments. Our capital preservation portfolio, which has a very small allocation to stocks, but really about 92% of that portfolio is also invested in bonds and fixed assets. As you can see right now, the yield to the trailing 12-month yield on our capital preservation portfolio is 5.67%. In our capital preservation fixed income portfolio, it's 5.8%. When you compare that to the aggregate bond index, their average is about 3.4% for the yield. And if you look at money market right now, money market's about 5.2%. So our bond portfolios are capturing a little bit more yield. But if you look to the year-to-date returns in the capital preservation portfolio, it's 3.7% year-to-date, 3.3% for the capital preservation fixed income only portfolio. And then the Bloomberg aggregate bond index is actually negative for the year. So we're blowing the bond index out of the water. And if you look at money market is only up 2.6% year to date. So the bond portfolios are doing better than what we're seeing in money market, and significantly better than what the bond index is doing. If you look at the 1-year returns, it's even more significant. 9% for capital preservation, 8.7% for fixed income only, 2.6% for the aggregate bond index, and 5.3% for money market. So what this is showing us, and what we think is important to highlight, is that if you have money sitting in cash, or if you have money sitting in money market, as the Fed starts to lower interest rates, the yield on money market is going to go down. And so you're going to start making less money in money market. And you're seeing that we're already doing significantly better in those bond portfolios. But the big benefit of the bond portfolios is what is to come. And that's the fact that when interest rates go down, the value of bonds increase. So if we're capturing somewhere around 6% in interest from those bond portfolios, we really stand to benefit greatly from some capital appreciation. As the Fed lowers interest rates and interest rates go down, we could see the bond portfolios do even better in that rate decrease environment. So 9% returns over the last 12 months and 8% returns over the last 12 months for those portfolios. That could continue on moving forward. And we really, really like this portfolio for conservative, safe money. You're going to get somewhat stock market type returns potentially in this portfolio in this coming environment. And it's still a very safe, very healthy, very conservative portfolio. Anything to add?
I mean, the one thing I would say to this is, just for context, I feel like this conversation is coming up a lot with a lot of clients, a lot of plans that we're working on. we're in a really unique environment politically this year, economically this year. And because of that, a lot of our clients are preferring to stay as conservative as possible. And rightfully so. I mean, you can stay in a money market account, earn a little bit over 5% and be fully liquid. That's incredible. But to Chris's point, a lot of that is going to change. And so what Gretzky always said was, don't skate to where the puck is, skate to where the puck's going. So to me, this really makes me think, even if we're wanting to be conservative with our smart money, it's okay, and it's probably a great idea to start getting that out of money market, or to be thinking along those lines and move that into capital preservation fixed income. I think a lot of clients get scared of like, well, I'm putting that in a model, and am I putting this at risk? And really, you're only going to be doing yourself a favor long term. The money's still liquid, right? There's still plenty of opportunity, and it's named capital preservation. That's really the goal of that portfolio. And you're going to do really well to have money in that for the next at least 1 to 2 years.
Yeah, the biggest negative for bond portfolios is when interest rates go up. And we're clearly not in that environment. That environment already happened. The chances of interest rates going up from here are pretty slim. And they're talking about lowering interest rates, which is a benefit for those portfolios. So it really is a great environment for these portfolios. And money market has been fabulous. It's been great being, at 4.5%, 5% for money market interest rates. But that is going to drop, and there is a time when you need to make the adjustment, and we think that time is here to start rolling some money out of money market and rolling it into fixed income and these types of portfolios. Another thing to note, he mentioned money market being awesome because it's liquid. All of our portfolios, we maintain liquidity as long as you're not in retirement accounts and have those issues, but all of our portfolios, we try to keep very liquid, very flexible. So we put a lot of emergency savings money into these types of accounts, earn a little bit better than you would get in your savings account or your money market at the bank, but still have liquidity and access to it if you need to get to it. So it's a great portfolio right now in this rate environment, and just something that if you're not using and you're not familiar with, please ask us more about it, because it really is, the risk reward relationship in this portfolio is outstanding right now. Let's talk about these wacky markets. What has happened? So let's look at this last quarter. This is a quarterly webinar, so let's see what's worked. Growth stocks up 8.3%. Obviously, that includes a lot of those Mag 7 companies that are dragging the market along for the ride. You look at emerging markets, so international investments up 5.1, which is something we haven't seen from them for a while. So it was a great quarter for that sector. Gold up 5%. Large cap equities of 4.3. Cash, not a bad place to be. Money market rates are good, those kinds of things, 1.3%. US high yield up 1.1. And then you start to look at, what hasn't worked over the last quarter. Europe, international up 0.9. The bond index we just talked about up 0.1. Emerging markets debt down. European debt down. Value stocks, dividend paying value stocks down 2.2%, small caps down 3.3%, Japan down 4.2%, and Bitcoin, I'm sure you guys hear a lot about that, down 12% over the last quarter. Where to find value in this market? So this is, as you saw in that last slide, value down 2.2%. Value has underperformed growth stocks for quite some time. 2021 was really the first year in a while that value actually outperformed growth stocks. It was a great year for dividend paying value stocks, but overall it's been a long time where growth stocks have definitely outperformed value stocks. And this shift has taken a hold on the markets themselves. If you look at the S&P 500 and the Russell 1000, only 21% of those two indices is made up of value stocks, or quote unquote value company, dividend paying companies. So it's become, and we continue to see this shift where more and more growth stocks are taking over the overall weighting in these sectors or in these indices. And it's becoming a growth driven market, which is largely due to the Magnificent Seven and just how much of a percentage weight they have on the overall different indexes. Narrowing the gap and widening the opportunity. You take this one. Your slide.
You got it. Wow, I'm honored. Thank you. So here we're really looking at the analyst expectations year over year from 2023 to 2024, and we're stripping out the Mag 7 from the rest of the S&P 500. So from those other 493 holdings within the S&P 500, and so many, the reason why we really dive into the S&P 500 so much is so many clients use that as the benchmark. And what our analysts have really been able to uncover is there's only a small percentage of the 500 companies in the S&P 500 that are really driving the performance of that index. And so what's really interesting in conversation I've had frequently is asking people when they say, oh, just put in the S&P 500 or use that as a point of reference. It's like, why own all 500 of those companies? Have you actually looked at the data for those companies to find out that in 2023, a lot of that S&P 500 growth was driven by the Magnificent Seven. You look at the first quarter of this year, and 80% of that growth was within the S&P 500 was driven by the Magnificent Seven. The other 493 companies actually pulled down the S&P 500 by about 16% there. So you can see through all those other periods, we're seeing similar in the second quarter and then anticipated for Q3 and Q4. Even this is just forecasted. That's where we're starting to see them hopefully even out. To Chris's point, maybe we're going to start to see more of that money funnel into the small market or the small cap, the value stocks, things like that. But again, that's just an estimation. So all that to say, when we look at an index like the S&P 500, something that we use to benchmark almost every other holding, let's really look at the data and allow that to direct our decisions on whether it makes the most sense to be a part of.
Yeah. And I would say that the Q4 number, that even though it's a forecast, it's something you have to understand from an investment management standpoint. We look at this a lot with the portfolios, that there is going to come a time where it's going to make sense to take some profits in things that have run hard and start looking for value in some of the areas that have underperformed. And so the Q4 forecast, I would somewhat agree with, in the sense that you're even already in July, you're starting to see a little bit of a sector rotation where you're seeing technology stocks start to struggle a little bit. Some money is coming out of the Magnificent Seven, not only from investors, but some of the executives at those firms are cashing in and taking some profits, and then looking for value in other areas of the market, which is something that we do as investment managers, is say, okay, when you have a stock like NVIDIA that's up, whatever, 300% over the last 18 months or whatever it is, there does come a time where there's not a lot of value there at the moment. And so you look for some profit taking and look for where is value in other areas of the market to keep yourself diversified. Staying on that diversification note and what's going on around the different areas of the market, global markets. So one of the big themes we've seen in kind of our core portfolios. So for those that don't know, our core portfolios are our broadly diversified asset allocation models. They're our oldest portfolios. I started those portfolios in 2000 during the dot-com burst. And so they were built around modern portfolio theory and Harry Markowitz's Nobel Prize on the efficient frontier in modern portfolio theory. And so broadly diversified asset allocation models that use, all different areas of the markets. And we have international exposure in those portfolios, but we have been underweight international for quite some time now, as the US has continued to drive the majority of gains and the international markets have continued to struggle. And we don't see that changing. There's a lot of issues coming that is keeping us kind of on the fence when it comes to international investments. And you can see it from this chart. Since 2020, China has been in a significant decline. India has definitely picked up pace. So India has done great and has done well. But if you go to the next slide, you'll see that China has been one of the dominant drivers of the international markets. So what China does really leads to what is the rest of the international or the global markets looking like. And with China continuing to kind of trip up and falter, you're seeing a lot of that business that was given to China is moving away. So what this chart is showing you is that 57% of companies that were investing in China have moved to Southeast Asia. 30% have returned back to the United States or moved to the United States, 29% to Mexico, 22% to India, and 23% to Europe. So companies are leaving China. China is in trouble. And right now, that's creating some difficulties for the overall global markets. Or those international markets, but there are some direct beneficiaries of where those companies are moving and where we may redirect those international investments moving forward if some of these other areas continue to pick up where China left off. We'll touch on this briefly just to give you an update. So these are our core portfolios if you own them. We have everything from what we talked about before, the capital preservation fixed income only bond portfolio, our most conservative portfolio, 0% allocation to stocks, 100% allocation to bonds, all the way up to our ultra aggressive growth portfolio, which the target allocation is 95% stock, 5% in fixed income and bonds and cash. And the returns, ultra aggressive growth up 11.23 year to date, all the way down to our capital preservation fixed income only at 4.6% roughly. What you'll see from this is a pretty steady increase, right? 4.6, 5.06, 5.5, 6.2, 7.1, 7.6, 8, so on and so forth. That's because these portfolios are specifically designed with the intention of having the appropriate risk level for each client that is in them and return target that we're shooting for each client. So the reason we have so many of them is when we build a financial plan for a client, we try to understand based on your objectives, based on your goals, based on what you're trying to accomplish, what is the rate of return that is appropriate or is needed for you to be able to accomplish your goals. And then we can pick and choose the appropriate portfolio that is going to give us the targeted rate of return we're looking for with the risk level that is appropriate for what your goals are and what your strategy looks like. So the reason we have so many of them, everybody asks us, is because there's so many of you out there with so many unique situations and different objectives and goals for the future. And so we pretty much have a portfolio that is in line with every different objective of every different client that we work with. And we have a model to be able to match you up with that is going to be suitable for what you're looking to accomplish. Run with it. Mag 7.
Wow, fun. Well, this is really just jumping on or adding to, what we had mentioned previously with really looking at the Magnificent Seven, the strength of just those 7 holdings compared to
Can I
the
stop for a
broader
second?
market.
For those that are listening that might not know,
I was just gonna.
what are the Magnificent Seven?
Yes, we have Facebook, Amazon, Netflix, Google, Microsoft, NVIDIA.
I think there's one more in there.
Is there? I thought that was shoot.
That's
is
all right.
it Tesla? No, Tesla's not. We had Tesla.
It's Apple, Amazon, Facebook.
Yeah, Amazon. That's one I missed.
I think it was Amazon that you missed. There we go.
All right, cool. I got a 90%. I'll take that.
Yeah, that works.
Okay, so if we look at those 7 holdings compared to some of these other indices, so those other lines that we're looking at, again, those are the reference point of the S&P 500, the NASDAQ, the international funds, and the Russell 2000, which is our small cap index, not ours, it's the small cap index. But you can see just the performance of those specific holdings in that glaring pink line, it's outperforming every other index. And so really driving the S&P 500's growth against those other 493 companies.
By a lot.
If we go to that next slide, we're going to dive into this a little bit more. So some of you are familiar with our tech and innovation portfolio. This is very similar to the Magnificent Seven, although we have a unique kind of 8th holding in there and consistently making changes here. But let's go back. Thank you. So what we really see, and I guess more the reason of, okay, why these Magnificent Seven was, do we just pick these and now they're called Magnificent and so they're going to do really well? No, it's we looked at what are the characteristics of these holdings and why are they performing the way they are? And a lot of the sentiment right now is, wow, they've done incredibly well, but where are we going from here? And so that's what we want to be very careful with, and I guess just be more disciplined with, because that is the nature of the beast, is these are very volatile stocks. So they're gonna go up, 40 to 90% in a given year, but that can also be followed with a negative 40% or 43% loss. If you look at that data from back in 2022, this portfolio down 43%. Ouch. That's not something that you want in a, stable account, or if you have goals in the near term. But 2023, last year's performance for this portfolio, 94% up, and year to date already up another 40%. Here's the thing that we look at when we're looking at tech and innovation. One, this portfolio is not for anyone with a near-term goal, right? So I would say anything less than 3 to 5 years, we're really, careful on that shorter term. We really want to push it out. Hey, these are goals, or these are funds that are designed to grow for 10 plus years. That's going to be the best beneficiary of this portfolio. But we still want to be careful, because I remember even in January of this year, tech had already gone on a 2 or 3 month run. And I heard a lot of people saying, man, this is, 2024 is going to be ugly. It's going to be an election year. To Chris's point, the headline's going to say this is going to be the worst recession in history. And look at what these holdings have done year to date, up 40%. And so had we made knee-jerk reactions like that, that's where we lose that incredible growth that we can take advantage of. And now, along the way, we're going to have certain runners. So, for instance, if you look at Apple really hasn't gone on a run until the second quarter of this year. But you look at NVIDIA, that's been running for the last 12 plus months. And so over that time, our investment committee and our investment managers are making those slight tweaks to maybe sell a little bit of that NVIDIA that's had a run and maybe buy more of that Apple. So it's not that we're just a buy and hold on only these 8 holdings. We're making shifts in between, just like money's flowing from tech to small cap. Even if you only own tech, you still want to be making those changes within those handful of holdings. And so that's what we're taking advantage of in our tech and innovation portfolio.
Absolutely. And I'll add to that. Yeah, I mean, to your point, the rebalance that happened earlier this year took some profits out of NVIDIA, and it ended up buying Apple because Apple had underperformed in the first quarter, and then Apple started to rise. So I call that tactical rebalancing. I'll also point out that I've been managing this portfolio for a very long time. This is not a new portfolio to me. Back in the day, they used to refer to them as the FANG stocks. So it was Facebook, Apple, Netflix, and Google. And my portfolio was the FANG stocks. And the reason that it was this weird combination of letters was it was Facebook, it was Apple, it was Amazon, it was Netflix, it was NVIDIA, it was Microsoft, it was Google way back in the day. So the Magnificent Seven that they refer to them today has not been a new thing to this portfolio or to me. We've owned NVIDIA for a very, very long time, way before NVIDIA was the largest company in the world, right? And so part of the reason this portfolio is interesting to me, and I highlight it here a little bit, and I'm going to take a little extra time for it, it is not for the faint of heart, right? In the last 5 years, it's dropped north of 30% on 3 different occasions. In that same 5-year period, it's up somewhere around 180% along that time period. If you look at it stretched out over the last 10 years, and that number's not up here, but the 10-year average on this portfolio is right around 35% a year. If you go do some math on taking some money, investing it in over a 10-year period, averaging 35% a year, the numbers will blow your mind out of the water of what the potential is there. The other things that's interesting to me about this portfolio is when I first got into the business back in the late 90s, the largest company in the world at the time was General Electric. They were growing by 6 or 7% a year, right? But they were big and they had a healthy balance sheet. After GE, it was ExxonMobil, same thing. Growth rates were decent, but they were dividend value companies, right? What's amazing about what has occurred over the last 20 years is the largest companies in the world with some of the healthiest balance sheets that we've ever seen are still growing at 26, 27% a year. Microsoft is getting smoked in after hours right now because their Azure cloud did not live up to expectations. They were expecting year-over-year growth of north of 30%, and their year-over-year growth was only something like 27%. But it's still 20, these are big numbers as far as growth rates are concerned on companies that are sitting on a ton of cash, very low debt. These are very healthy, very large companies that are continuing to grow at some astronomical rates, and artificial intelligence and AI is only going to push that even further. So this portfolio is being adjusted a lot. We're always looking for new people or new companies to add to it, and AI may add to that in the future. But this is a great portfolio for people that know they've got a long time to invest. Maybe it's not their life savings, but it's a good smaller piece of what they have to invest. Always say this is a great portfolio if you have a big core portfolio in your main investment account, maybe our stock 100 in your IRA, and if you have a smaller Roth IRA, this is a great portfolio for that Roth IRA to grow tax-free until you decide to pull that money out down the road, because the numbers do not lie. It has been a great portfolio for a very, very long time, and it owns really, really good companies. You just got to be able to stomach the ups and downs with it. This goes back just more about the high level of concentration. The top 10 companies in the S&P 500, you'll see, I can't see the number, we're north of 35%, I think, as far as the weighting in the S&P 500. And you can see we haven't been anywhere close to that until you go back all the way to the 60s, right? Totally different environment. And look at the spike that has happened just in the last, 10 to 15 years right there. You've seen just a huge climb in what's happening there. So the point of that to remember is if you go by the S&P 500 index right now, you really own the Magnificent Seven. As Robert was pointing out earlier, the other 493 stocks are doing nothing or losing money, and you're basically buying an index that is predominantly the Magnificent Seven already. So my question always to people is, why not just go buy the Magnificent Seven? You run with it.
Okay, perfect. This is really just gonna add another layer of kind of the overall theme that we've been highlighting regarding the Magnificent Seven. But if you really look at the three key players in there, so Apple, Microsoft, and NVIDIA, you can see that just over the last 12 months, because of NVIDIA's historic run, you can see the market capitalization reaching that of Microsoft, of Apple, two of the largest tech companies in the world. And so I believe on one of our other slides, it even highlighted that NVIDIA has surpassed the market cap of both Microsoft and Apple. So really just speaks to the general run and strength of that one holding.
And when this rolls into talking here soon about our stock 100 portfolio, another portfolio that gets rebalanced, tactically rebalanced over time and moved around. One of the things that, I like to highlight that we did, and it's important because you learn from it, right? I always say, if you missed out on this opportunity in the past, don't make the same mistake in the future, right? I always tell my kids, we all make mistakes. I make mistakes all the time. I just try not to make the same mistake twice, right? So in 2022, NVIDIA was down something like 65%. When we hit October of 2022, NVIDIA was just one example. I think, Google had like a single digit PE ratio. Tech stocks were they looked incredibly cheap on paper at that time. And what did we do? We tactically rebalanced our stock 100 portfolio, which sold things like Chevron, pulled money out of those stocks, and it went and bought NVIDIA in October of 2022, which looked, just seemed like the right time when a stock as good as NVIDIA, because it's always been a great company, was down 65%. What better time to add money to it? And obviously, for those that own the stock portfolio, you have seen the benefit of that over the last couple of years, where that stock portfolio has been on fire because we bought NVIDIA and Google and some of those names at the right time, and they've just been off to the races the last couple of years. All right, election year. I've said this a lot, and we'll highlight it again here. It really doesn't matter. This is a chart showing you the markets, Republican, Democrat. And there's no real drastic difference between one or the other. Everybody likes to say, you know, one is better for the markets than the other. And what we see historically when you look back over time, it really doesn't matter. It's more economy driven, whatever you want to call it, event driven, things that are happening during those different election time periods or those terms. But very little of it really has to do with whether a Democrat or a Republican is in office during that time period. So just want to keep reiterating that so that you don't fear one versus the other with regards to your portfolio.
I was gonna say, we should have updated that of $1,000 put into our tech and innovation fund in 1933, and that would have been way cooler to see.
Yeah.
Anyway, sorry, next slide. It's me just
Yeah.
going off topic with my ADD.
Yeah.
So let's talk about this a little bit because again, it's been a common theme in client meetings this year. And how do we handle or navigate investments while the election is happening? And one of the things that we've been thinking about and talking about is, okay, well, we want to think about whoever's in office come December, what are their initiatives going to be and who are the beneficiaries of those initiatives? And so this chart is going to outline, hey, if we get a red wave here come 2024 or this election into 2025, you know, banks, financials, aerospace, defense, a lot of these healthcare, oil and gas companies should do well, right? That would be our theory based on the initiatives they stand for. And then if we get the potential of a blue wave going forward, who are going to be the beneficiaries on that side? We have the renewables, the energies, telecom, home builders, industrials, tech, and manufacturing. So a little bit more of that value play. But what's really interesting, if you go to the next slide, is it's actually going to highlight a couple things that would be contrary to belief. And so with that, if we look at the last two presidencies, so we have Trump from 2017 to 2020, and then Biden's presidency 2021 to 2024, we actually, our investment team looked back and analyzed, hey, out of all the sectors, what was the cumulative performance over that 4-year period for each of these sectors? And so ranking them from best to worst, you're actually going to find that the results were contrary to what most people believe. And so this is where we're positioning our portfolios based on history as opposed to just speculation, because we never want to speculate. And so some of the things that stand out are, you know, energy doing as well as it did under Biden for the last 4 years, when typically under a Democratic office, we wouldn't see as much of a run in energy. But what tends to happen is, for these last 4 years being a great example in energy, is because energy was so restricted, we actually saw the price of oil spike up more than it was during Trump's office. And so what that does is it creates very high values for those energy companies that are now selling their commodities at a higher level than when they were previously. So I guess all that to say is we're being very diligent with how we play, you know, in either direction come the end of this year, and looking at data like this as opposed to just speculating generic industries.
Yeah. And to add to that, first of all, if you guys haven't met Eric Abrahamian in our office, Eric is our newest analyst at the firm working in our research department, and he puts a lot of this information together. He is sharp. He knows his stuff, and he is a great addition to this team. And so he feeds us a lot of this information to give us, you know, ideas of what we should do moving forward. And so one of the things Eric and I have been talking a lot about and we're working on right now is a game plan for both scenarios. So what are we going to buy, or how are we going to adjust the portfolios if Trump is your next president? And what are we going to buy, and how are we going to adjust the portfolios if Kamala is your next president? And knowing that ahead of time, so that once we see the results of the election, we're already ready. We've already done our research. We're already ready to move. The things that are important here is, like what Robert was saying, is most people would tell you go buy energy when Trump gets in office because he's pro fossil fuels, and if Kamala takes office, she's anti fossil fuels. But that's not always the scenario. So you have to understand it and dig a little bit deeper. One of the companies that Eric and I have been talking about recently is Occidental Petroleum. Occidental Petroleum is an energy stock, but it has a heavy influence in the Permian Basin, which is here in the United States. And so that, out of all energy stocks, if Trump is going to become president, and he decides to allow more production of oil here within the United States, they might be a company that's a direct beneficiary for something like that. So those, digging a little bit deeper, energy stocks didn't do well when Trump was the last president, but there may be certain ones that stand to benefit because of his policies, and vice versa. There may be others that aren't going to benefit from Kamala's policies. So we're really trying to map that out ahead of time and know what are the adjustments and the moves that we want to make, regardless of the outcome of the election. The other thing I'll point out, I say this a lot, most markets, if you go back through history, markets tend to do relatively well post-election. There's just different sectors that take off first. So last time Biden took office, if you go back and look, clean energy stocks took off like wildfire. They didn't do so well after that, but the initial surge was on the idea that clean energy was going to be the focus. And so when Trump took office last time, tech stocks took off because they figured he's pro big business and he's going to. So you just want to understand these things. But in both scenarios, the market took off, just different areas of the market led. Stock portfolio. So our stock portfolio is our baby. We love the stock portfolio. It's become one of our flagship portfolios here. Just the risk reward relationship has been outstanding. And it's done a really good job of outperforming not only on the upside, but doing well of mitigating risk on the downside. As you can see from some of the numbers stretched out over the last couple of years. The portfolio is up 19% year to date compared to 17% for the S&P 500. It captures a lot of the upside and does a really good job. If you look back at 2022, the S&P was down 18% and this portfolio was down 13.6%. So we're very proud of its ability to capture the upside, but reduce risk on the downside. And we do that through sector distribution and diversification within the portfolio. And so that's what we continue to do. We look at different market environments and try and determine what areas of the market do we want to own in this environment. And so going into 2021 and into 2022, we reduced exposure to tech. We added more dividend paying value companies. And then, like I told you earlier, towards the tail end of 2022, when tech had been decimated, we rolled back out of those dividend value companies and we bought and added to our tech positions. Now we've just recently rebalanced and pulled some profits out of tech and we're looking for other areas. So it's that ebb and flow of looking for when is the time to take profits when things are high, and looking for opportunity when things are low. And one of the other themes I'll point out that we're looking at a lot right now is interest rates. If interest rates are going to start going down, what areas of the market are going to benefit from that? And so I'll just highlight one we're looking at is real estate. We have had limited exposure to real estate in this portfolio for a couple of years now. Thank God, because real estate has not done well. And so it has been to our advantage to have limited exposure there. But as interest rates potentially drop, we could see real estate start to turn a corner. And so we're currently scouring the markets, looking for what are the best positions or best companies that we think can take advantage of that and do well in the portfolio moving forward, and looking for opportunities to slide those into the portfolio to take advantage of that next move that may be coming. So we're constantly doing that in this portfolio, is sliding things around based on what we see. And like that slide we saw earlier where the Magnificent Seven started to come in line with the other 493, right? There's opportunity in those other 493. So we're looking for that. Where are the companies that have underperformed, have value right now, and stand to benefit from what we see coming forward, and making those moves ahead of time so that you guys can benefit from that. And we are continuing to limit the downside and take advantage of the upside that the market is presenting for us. So. That's it.
That's it.
That's it.
We made it.
Well, thank you guys as always for listening. Hope we added some value and gave you some things to think about moving forward. If you have any questions, as always, please feel free to reach out to us. Any one of us, any of your advisor or any of the team are happy to, chat with you about what's going on in the markets or the portfolios and in particular. And other than that, we hope you have a great third quarter. We'll look forward to seeing you guys on the third quarter webinar somewhere around October. And that will be real close to the election at that point. So we'll have lots to talk to you guys about at that webinar. And until then, hope you guys have a great day. We'll talk to you soon.
Advisory services offered through Prosperitas Financial, an investment advisor registered with the U.S. Securities and Exchange Commission. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Past performance does not guarantee future performance. All the views expressed are those of Prosperitas Financial and do not offer tax or legal advice.